Good morning, everybody. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by TradeRate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on TradeRate's main platform as well. They're a great way to get exposure to the futures market with limited risk. You can go to placeyourtrades.com and get the TradeRate app for free. I also write a weekly blog and daily pre-market at placeyourtrades.com, which is absolutely free. So you can just go to placeyourtrades.com and sign up for that. I will be doing a summary of this episode with my key takeaways that will be available for download as a PDF. And if you're interested in getting the PDF, you can click the link in my feed. I'll also put it in the nest or visit placeyourtrades.com/spaces to sign up for it. And it'll be available and emailed out to anybody that signs up. And before we begin, just as a reminder, this material is presented solely for informational and entertainment purposes and not to be construed as a recommendation, solicitation, or an offer to buy or sell long or short any securities, commodities, or related financial instruments. Please contact a licensed professional before making any investment or trading decisions. And now with that, let me introduce our guest. You guys, when you're not speaking, can you put yourself on mute so we don't get a feedback? Sorry. First, we have Jason Tidwell. Jason began his trading career as a retail commodity broker in 1996. He landed a job on the NYMEX floor in the natural gas pit in 1998 and traded as a COMEX local in the mornings before the gas pit opening bell. He left the floor in 2000 to take a physical and financial natural gas trading job at an energy company back in Houston. He switched companies in 2003 to run the derivatives desk at another energy company in Houston. In 2010, he left to trade private capital structure and switched over to a different private capital structure in 2012, running it until 2016. From 2016 to 2021, he traded his own capital. And in 2021, he took on some clients and now is in the process of setting up a fund that should be operational around the end of January. So congratulations on that. And next we have, I just re-invited you to speak. I saw you just fell, Andrew. Next we have Andrew from Traders Community. His experience as he's been head foreign exchange trader, managing over $1 billion in positions. He's traded all majors, crosses, and peripherals. The U.S.-based traded U.S. Treasury bond and CMO marketed bonds in Europe and the U.K. He's traded on National, CAC 40, DAX 30, and bond futures, equity, and S&P futures and options. He's developed trading algorithms and trading systems. He's traded foreign exchange and energy futures and options. He's traded foreign exchange and energy futures and options. At his peak, had 80 million under management and profitable with a peak 10 million PA with a typical trade book with 1,000 lots, options, and futures. He's also traded for a family office, equities, indices, futures, and options. And with that, hopefully we can get Andrew back up here. I just invited you back to speak. I want to start off with, this question is for both of you. Hopefully we'll get Andrew back up here. But we'll start with Jason, since you're up here. What did you think of the EIA report today?
I don't really track the crude nuts and bolts as much as you guys and Andrew. I'm more of a natural gas guy. I guess you would call me more of a crude tourist, being in energy. So I just look for not necessarily the day to day or week to week. I just look for larger setups based on where the fundamentals are going. And for me right now, crude is I don't think I've really touched crude much than just having some lotto tickets with the geopolitical background set up, just buying cheap out of the money calls, just to wear on the book in case something crazy were to happen. Um, but yeah, I mean, it seems like if you look at the price action of the crude complex over the last several months, that it's just kind of back and forth in here, which kind of tells me that things seem to be fairly valued. Doesn't really seem to be an axe to grind, long or short here. So, um, I mean, that's my crude take. That's not my main market.
Okay, I managed to, for some reason, it was difficult getting back in there. Story of my life, really. Um, so what I'm getting more and more out of these data drops from EIA is just how different they are to what the analysts think, and probably one of your pet topics, how different they are to API. And if you look at the Cushing number, they're just so different now. If you remember back, when we had Glencore, we'd all focus on Glencore. Everything was pretty accurate. And as far as the pricing goes, it's much the same as what we were talking about last week I was on, last month, I think it was. We're very much in a market that's run by paper. And I think as far as OPEC goes, they're, they're all, I use the word delusional with them. They're so out of whack with how markets trade. And I think many are that way as far as investors are. And as we know with oil, people tend to get uber bull or uber bear rather than what price action is doing. And I agree with Jason. We're right in that slot of probably 85 on the top, 65 on the bottom, well, say 70 on the bottom, where everyone's happy with, except for your blood speculators or your uber bears, right? So I think in reality, the more OPEC worked out a long time ago, the more they talk, the more it keeps markets covering and covering, particularly if paper's working. That's kind of my take on what I saw today. We saw those huge product builds, but that's probably more a factor of the refineries coming out of maintenance, you know?
Absolutely. And so, and since we were just talking about how we're kind of been in a range bound yet volatile market, I would say.
Yeah, yeah.
So, trading wise, how are you approaching this market right now?
Much the same way I've been doing for probably quite a while now. And I think so those charts that I run off, the daily and weekly, um, I base an option book off that with futures. So in other words, if it's pretty much 70 to 80, go either side of that. So you'll try and be long at 70, short at 80, and using options to do that. And you'll take them up and down as they scale. And vol is still high enough that becomes fairly safe. In other words, you'll have enough build up if you're wrong. So you know where you're wrong pretty quick. And if you look at an oil weekly, it has been in a constant downtrend since that high when Ukraine got attacked, right? It's been pretty well been in that high. It had one spike up. Was it 5 weeks ago when Hamas attacked Israel? And ever since then, it's just been back in that trend. So I just trade off that basically. They're my price points. So I don't believe in just straight out delta covering on options. I mean, when I first moved from Forex and bonds to commodities, that was my big advantage because I was shocked how some of the big commodity desks traded them, right? More on I never understood why they're getting long calls at the top and short puts at the bottom. I'm sorry, long puts at the bottom. And we still see that today. And as you know, our friend Greg, who runs Commodity Vault, I find that information really valuable on two ends. One, how much is going through, like what's the outstanding, but also the vol at those levels. So I kind of put all that together. And years ago, we built an algorithm based on mathematical models, which is now becoming in vogue, which is good. So until that breaks, then I'll have to find another way to trade.
And then, how do you think, I mean, obviously there's a million headlines around OPEC meetings. That's why I don't even like
Mhm.
to post them because, it's just a lot of sources say.
Yeah, yeah,
So,
yeah, yeah.
you don't really know. But how do oil markets, like, quote unquote, win coming out of this OPEC meeting? What do you
Well,
think they want to see?
well, what I think's really going on, and talking to some of the, so basically, oil's really run by the VTOLs and that of the world, right? In my opinion, and I've seen it more and more. Trafigura, Glencore, people like that. I think the US, we do run it, but not from a Biden or Trump perspective. In other words, whoever's in charge. I think Exxon, Chevron, very smart operators. Um, and so if you put that around the world, who does that affect? Well, we all know the cap's a load of crap with Russia. It hasn't worked, and the politicians don't understand it. So I think looking through all that, what you're seeing going on is more a big political play in OPEC, because really OPEC Plus is now KSA and Russia, who loathe each other, right? We all remember, I think one of my biggest whackings on oil was when Russia, remember that weekend where Russia went to war
Yes.
with Saudis? What was that, 5 years ago? Like a wet close at 45, open at 37 offered, or something like that. So that's still in the back of their mind. We saw today, uh, what do you call it? KSA, olive branch to Iran, who are again another one of their enemies. They've got a lot of enemies, these guys, to try and stop or slow down what's going on with Hamas and Israel, right? So all that's in OPEC in the mix. We know that the African nations don't want to cut back. So the word I'm hearing on that, that's a lot more to do with Russia trying to get a hand back against China with what's going on in Russia. I mean, sorry, in Africa. Africa has to keep producing because they've got to pay China off. There's all these other little variables, right? It's not just, oh, they don't like America or they want to get, and we know they've got to get the price up because we all saw their GD. Remember, I think you made a good mention of that last week about how bad KSA's GDP report was. So they need that revenue. For us as Americans and oil traders, it's all been fantastic for America. We've got more production than what we all thought. So that's kind of my take on it all.
Excellent. So we'll come back to you, Andrew. We'll go to Jason. And let's talk nat gas since you're the nat gas guy. So US is selling more than ever right now, yet prices can't seem to get off the floor. And many are asking, why is this happening, particularly, with the build out of LNG and with how much we're exporting to Europe now. So what is your take on that?
If you go back to the very end of the 90s and early 2000s, well before shale, um, we were getting, let's say, 20%, and sometimes maybe a little bit more of our production from offshore. So that's when, hurricanes were all the rage. You get a hurricane, would take out infrastructure and natural gas. We had several cycles in the early 2000s. In fact, 2000 was the first year that we reached $10. Before that, it had been up to like 465, I believe, on shortages. But, you know, the appetite for gas grew enough back then, and we were still just running off of the, traditional vertical type um, extraction methods. So, it got to a point where we'd built out enough of a demand base that these little cycles played out. And, we hit $10 in December of 2000, came off hard and cycled back up to, there were several cycles in the 2000s period that got up into the teens. The last one being in 2008, which we were already somewhat short supply. Um, and then you added in that we lost about a BCF a day away from the Independence Hub platform in the Gulf. It had a leak and it was down pretty much all summer. That ran this market up to, I believe, like 1350, something along those lines. And from then, shale was discovered. You know, they unlocked Haynesville in late 2008, and since then, they built out this huge onshore infrastructure, and the offshore areas just became, kind of not as important. And I think right now offshore is only producing, I think, somewhere in the 3 to 4 BCF a day, which is just, it's not much at all. Um, and we've lived in this overproduction phase of shale where these companies had spent so much money obtaining the lease properties. With Haynesville, there were areas where they were paying 25 and $30,000 an acre for a lease at the heyday of that, between Chesapeake and Petrohawk and a few of those companies. So with all that capital outlay, they had to produce, and they flooded the market with gas. And we spent a good chunk of the 2010s decade with just these very low prices and overproduction. It became a cash flow game where these companies had to produce, even if it was netting them a net loss, just to keep the cash flow alive. That played out until, when the lockdowns hit in 2020 and everything looked like it was falling apart. We finally saw some decent bankruptcies and reorganizations and mergers and whatnot. And because they laid the rigs down so bad, that set up the cycle that uh, took natural gas up to $10 last year. We just wound up finally, for the first time in over a decade, coming truly short on supply. Um, so with that $10 move, that basically set the stage for another cycle of oversupply, which we've been in, a good part of the last year now. Um, a lot of people, including myself, kind of thought we would peak out maybe a 102, 103 BCF a day of production, and slowly start seeing some declines setting in, especially with fields like Haynesville. We've been receiving a decent chunk of associated gas out of Permian, which is really the oil play. So gas is, for the most part, is a byproduct, but out of Permian, it's huge. It's a lot of gas that comes from that play, and it's only constrained by pipeline takeaway. If there was more takeaway, we'd probably have more gas out of Permian. But we're dealing with that cycle right now, and the surprise is that we recently, in the last couple of weeks, have ramped this market up to, I think we've hit over 106 BCF a day of supply in a, $2 environment, which is, kind of absurd. But part of that, I believe, is if you go back to late winter and early spring of earlier this year, the spreads were so uh, wide that if you're a producer and you just completed a well, let's say in Haynesville Shale, the price was $2, two and a quarter. But if you waited till January, which is now the prompt month contracts, those spreads were netting you somewhere in the $1.50 to the $1.80 uplift range. So talking to some producers, what they started doing was they decided to drill and complete, but rather than turn that production in line, they wound up keeping that offline, selling the January, February, March contracts, and bringing that initial production on, targeting, let's say December, January, February to turn that production online. So um, how we got this bump to 106 kind of defies what those spreads were showing, but here we are. Um, so it's just a matter of letting this market finally get into some kind of decline. I don't think anybody's really making any decent money from a production standpoint at these prices. If you look at the hedge book uh, from a lot of these producers, it seems like most of these people they didn't take advantage of the run up when we had the $10. They thought we're entering this new era. So I don't think many companies have better than, $3, $3.50 hedges on. They just watch this market come back down. And so it's a tough area right here. It's just one where it's just going to take time to allow this cycle to play out again. And on top of that, you've got a lot of producers that are targeting, late next year, bringing on new LNG capacity. And so they're not really willing to lay down their rigs and their frac crews to the point that they should be. So it's created another environment where we're living with these low nat gas prices. It's just there's just too much supply.
At what price do these guys stop producing? I mean, when it goes I mean, we've seen like Waha go negative before, right? So, I mean, what kind of price are we looking at for Henry Hub where producers would stop producing so much?
Well, we had a lot of cash spot prices, sub $2, at various points throughout the summer, especially earlier in the spring. And they're just focusing on the forwards, trying to basically capture their hedges on whatever volume they did. But if you look historically, you don't see gas producers shut in production easily. The only production that ever gets shut in, it seems like, is from freeze offs. Occasionally in the past, you'll see where the Appalachian producers up in like the Marcellus and Utica, if cash prices got down just, bare bones levels, that you could see some level of shut in. Um, but yeah, the behaviors is defied for over a decade. We've all asked ourselves why these guys kind of keep shooting themselves in the foot, but here we are. And as far as Waha is concerned, considering that that is a point smack dab in the middle of the Permian, and that's associated gas, which, they don't want the negative pricing, but they're after the oil more than anything. So, hmm, so you'll see those negative prices. And part of that is with capacity constraints.
So how are you playing this market right now or trading this market or playing this market, within the medium and long term? Or I should preface that with, I don't know what your time frame is. So what is your time frame on trading? Are you short term, medium term, or long term? And then what is your view on this market and how are you
So
playing it?
currently, I don't really have any big axe to grind, long or short here. I'm looking for these setups, and a lot of these trades are already kind of oversubscribed, in my opinion. I know it's been a popular trade to play the Cal 24 and Cal 25 spread, where people are short in 24 and they're long the 25. That's a fairly crowded trade, and a lot of that is premised off of the addition of new LNG send out capacity coming online at the end of 24 and into 25. So, you couple that with kind of an expectation that this cycle is going to play back out by then as well, and we will start to see some decline sometime in 24. It seems to be these declines are taking a little bit longer than expectations because, like I said earlier, I don't think anybody had, dry gas up at 106 BCF, in the month of November. That was just kind of a shock to everybody. But, natural gas really is a two seasonal commodity. And it's almost like you're trading two completely different markets. You've got your winter season. Um, we spend all summer injecting as much as we can to get to a comfortable level, which is somewhere in the, 3.8 to 4 TCF range is, that's a pretty full tank, and we hit that area this year. We hit up into 3,800s on that, and so we have this full tank going into winter, and then weather obviously becomes king at that point, and not having early colds, sustainable cold in November and or December, that sets the ending expectation of how much gas you're going to carry out of winter into the next, summer cycle. Um, that sets that up. And currently, I believe most people have a expected uh, winter carryout of somewhere around 1.9 TCF, which is, fairly close to where we were last year, I believe. Um, and that's not really bullish. So, to really get this market kind of cooking again, we need to see some combination of some decline setting in, which I'm not holding my breath on right now. And we need some weather. We need some kind of more locked in kind of, cold over a chunk of the country. And so far, we're just not getting that. The forecast just don't look good. It keeps teasing some cold, and the models take it away after a little while, and so we're just kind of stuck in this area here where it's going nowhere fast, really. Um, so there's not, when I'm scanning the markets, I don't see a lot of opportunity out there at the moment. I'm just kind of waiting for that next setup, whether that be a weather system coming in, locking some cold in for a period, because we've cycled down now from the highs. We've got a short market, so you have the ingredients for another kind of mini cycle up here. Nothing major, but we're waiting on weather or decline or something to set in. But outside of that, it's hard to buy Cal 25 when it's such a crowded trade already.
That makes sense. And then back to Andrew, and then we'll come back to Jason again to do this in a round. But um, let's go back to oil here for a little bit. And given that, I mean, oil prices have been, again, you know, rangy but volatile. But we've still remained relatively high compared to historical norms. So
Right.
why do you think that oil equities haven't performed better, especially when, with earnings, they're still blowing it out of the water, comparatively speaking, to a lot of other sectors?
Well, firstly, I just want to add just a couple of things that Jason mentioned, which people who trade oil or natural gas from afar mightn't be aware, but he made a very good point of what's going on in the Permian, and you mentioned Waha. So as long as these oil prices are this high, all that least condensate or associated gas um, is producing or allowing natural gas to be overproduced, and they're gonna. I mean, unless they flare it, they're gonna flog it, right? Um, just back to equities, so I kind of look at the major. So if we look at oil equities, you got to look at them as stocks as well as the oil and gas commodity. So you've got I guess if you want to use what's gone on, so really what runs the S&P is those 7 big stocks, as we know, Apple, Microsoft, etc. So in oil, you got the equivalent with Exxon, for example. As far as dividend plays, I think what hurt the oil sector was people got way ahead of themselves and punted on it. Does that make sense? Like, so everyone was bearish oil stocks 2 years ago. I think we talked about this last time, sold them in the hole. Then they all started buying them way up the top. Right? So that's still settling its way through. Then we had a recent wave when Exxon and Chevron did 2 big takeovers. So that pushed that second or third tier up again. So that's coming down again as they lost it. In the meantime, high interest rates make dividends not as attractive, right? So I think they're the factors going on. And at these levels, look, oil at $75 is great historically, as and we saw the last earnings reports from Exxon and Chevron and Phillips, all these guys. So I think it's more that, and I think there's a lot of people just not in the stock market anymore. We've seen how many now uh, buy mutual funds, and so the dynamics changed, or using money managers because it's got cheaper, or just buying the spider, or just buying a similar ETF, which Jason's probably got a bit to say on Boyle and all these other things, because that causes those pops in natural gas, and so the big natural gas bloke. So I fiddle around in it like twice, 3 times a year with a decent size. It's seasonal, as Jason said, but what they're doing is shorting it, selling puts against it as vol's up. So, and then when vol comes down, it's usually down near the bottom. They know the Boyle freaks, etc., are going to come in and buy it, so they just buy out of the money calls real cheap to hedge themselves. So I think that's the setup that's been going on for probably, I don't know how long, 9 months maybe. Does that answer some of those questions?
Yeah, and then I'm going to get your thoughts on, we've seen a lot of spec lengths taken out of the crude contract, in both futures and the ETFs. We've seen a lot of length, length come out of USO, for example, which one could argue is not a bad thing, as we are still amazingly holding over 70. So, what are your thoughts on, on this? Why is everybody bailing on this market?
Well, I think it's not as bad as what happened in Natty. I think so many people lost money on it, speculators. That's why we always kind of joke about the dribblers. So they tend to buy oil at the top, average down, average down, average down, or buy the dip, however you want to say it. And they keep getting. They don't understand. Also, you got to roll. And we all remember when we had that negative thing 3 or 4 years ago on crude with the COVID, but how much USO themselves stuffed up that, right? I think that's a lot of it. So that means a lot of people just lost money on ETFs. They probably overweighted themselves, thinking that oil, because all you read about from analysts who analysts basically is they can't trade, is oil's going to 100, oil's going to 150, oil's going to 200. When it's has an up day, when it has a down day, it's the end of the world, massive recession, etc. And I think people, just what I see, the majority of the way people trade, they're selling a dip, buying the rally, and eventually it's just weeding them out. And that most oil trading and natty gas trading, particularly options, is done off the market. So, but there is advantages. Sorry, most of the hedging volume, etc., going on runs. So the speculators run right into it, right? So it hits $80. Oh, this going to 100. Your big oil firms will hedge, as Jason said, on natty gas. Same thing out on oil. They'll use that financials. They've got the real production, and so the speculator doesn't have the push going through. And KSA doesn't even get that. The moron there calls us ouch and speculators. Everything. It's always someone else's fault. So I think it's a lot of that, and the end result is lower volume.
So, kind of adding a little bit to that, you brought up the hedging again, and I wanted to add a little bit something to that. So the last energy company I was at for 7 years, we had about 220-ish different, smaller, intermediate sized producers that we aggregated their gas and marketed for them. And out of that 220 producers, we would do this twice annual producer conference in Shreveport. And we would have all these people show up to come have their lunch, and we would bring weather guys to come in and give the weather outlook, what had happened, and all this. We'd lay out all these cases, and if we thought you know, hey, we see some downside here. We think that this is a good area. You guys, you know, thinking about some kind of hedging. You know, we're negative on the price outlook over the next, you know, 6 months or whatnot. The interesting thing about that was we would hedge for every producer that we represented if they wanted it, but we could only get about 10 or 12 of those 220 producers to do anything with hedging. It's just this mentality of that producer mindset that um, hedging is like, you know, they're like what Andrew was talking about is just, you know, buying stocks at the highs or selling stocks at the lows, you know, and we saw it with that run up last year in natural gas to $10. Nobody really took advantage of those high prices on the forward curve. And then you start reading through these quarterly reports on their hedging program, like they got $3, they got $3.50. You know, they left so much on the table. So I don't know how much of that goes to the crude side. We didn't really represent crude players. It was mostly natural gas. But having, you know, 10 or 12 people out of 220 that would do any kind of hedging, you know, I think that's kind of representative of the industry in itself. It's just, you know, it's available and you kind of see a big lack of it.
Yeah, in some of those smaller firms too, the guy who's on the desk, maybe, you know, well, this is what I've seen a lot in natty gas, is a lot of these guys, they'll lose a lot of money, and so they'll go through firms, so they end up at firms down the end of the spectrum. Then they're scared to act on it, so they push the decision up to the directors, and so but by the time, if we take, say, $10, $8, and I see this in different markets over the years, say it's 7, by the time it gets to the board, it's 10. Then they go, it's going higher, or they don't want to make a decision, then it falls to 6, um, et cetera, et cetera. You get that pattern. I mean, and to give you an idea, Exxon, who is the biggest private oil company in the world, didn't even have an effective treasury function until a few years ago, because they would do all their hedging. They had one back in the day, they stopped it and they restarted it, I want to say 4 years ago. They did all the hedging horizontal and geographical, meaning they would have production in certain countries, so they'd hedge the Forex, marketing in another country, et cetera. And they were paranoid about being accused of influencing markets. So that was one of the reasons they didn't do it. So that's one of the biggest doing it. Then we know BP had a really active hedging desk. So it's all very different from what's happened. And from what I understand, one of the reasons Exxon got back into needing hedging was when they took over XTO, they just saw how bad that book was, which is exactly what you just said, people not hedging and stuff like that.
I think part of the problem might be, and correct me if I'm wrong, but from my experience with a lot of these companies, that the people at the top level management of a lot of these E&P, especially the smaller and mid-size, are engineer backgrounds. These guys are
Right.
petroleum engineers or chemical engineers or something along that line, you know, geologists. And they don't have the trading market side representative of that top level management, you know, and it's almost like it's, you know, a second thought. And
Well, they just have they have a really bad opinion of it too. I mean, they're ignorant of it, and it's not just oil and gas companies. I've been through it personally. On other companies have no idea of the exposure to interest rates, to currencies, to commodities, and then if you have something like Enron come along, then that just puts it back again, right? So then what was that bloke? Uh, can't remember his name now, but remember that when Bill and John made all their money on the hurricane?
oh, you're
Yeah,
talking
yeah,
about Brian Hunter.
yeah. So when you have something like that, it's like it just they. So there's two ways of looking at that. One, the guy tried to move the market too much in a very thin market, and you had the other side of it, right? So every market is a buy or sell. And then he had to go get out of that book. But that isn't going to typically happen in a market, you know. So I think and they're just scared of being wrong. I think that companies these days run their companies too much to what markets think. I mean, kind of the Fed does that too, right? So they're scared of being wrong. So that bloke at $10, when he should be at least hedging, say 30% of his book, the company, or whatever, you know, be conservative. Then they're scared of doing what happened back to Chesapeake back in the $13.50 you mentioned earlier, you know? So I think there's a lot of just total indecision that goes on, and it's not good, which makes us an opportunity, of course.
It's interesting. So I'm going to share the craziest hedge trade that I was ever a participant in was that Independence hub that I talked about earlier when we went up into the teens again off of that loss of production right before Haynesville was discovered and exploited. We had a producer that they hedged. I want to say, if I remember right, it was like a 9 to 12 month strip when we were up at the $10 area. And it was a really good price that they had locked into. And the market kept going up. And they would call, hey, what's going on? This thing keeps going higher. And we were like, they're just waiting on the Independence hub to come back. And when it does, this is all going to come back down. Well, they wound up lifting that hedge. And I fought tooth and nail to have them leave it on, but they decided they wanted to take a shot that it was going to go even higher. And they lifted that hedge at about a $2.50 loss. And not long after that, the Independence hub came back on, the market falls apart, and they never re-hedged anything on the way down. So they effectively took about a third of their gas and locked in a $2.50 hedging loss to it. And of course, the market dropped down into, if I remember right, the 2 or 3 handles at that point. So they effectively were giving about a third of their gas away for nearly free.
I think I remember. So was that the big lift that happened that forced Chesapeake to have to cover? I think it was around that period, right? At 10 to 13.
Chesapeake.
Or was it the second bounce?
When Aubrey was at the helm, he did some really, I don't know how to say this. He did some very creative things. And
yeah, we know the stories.
I always poured through those quarterly filings on their hedge program. And there was one quarter that popped up where they all of a sudden listed all these new natural gas swaps at a price that we hadn't seen in 6 months or longer. And everyone scratched their head going, how did they get these on? So you read a little bit more into the detail, and what Aubrey did was they sold a bunch of crude calls. I want to say it was $110-ish crude call strip that they sold. And they used 6-to-1 BTU conversion, and they labeled them as natural gas hedges, even though it was nothing to do with gas. It was actually a short call strip in oil. And that was famous. I know Aubrey was sweating it because there was a period where oil started rallying again, and they didn't have the oil against it, and gas was down. So I mean, it was.
Where was it? Who was their auditors? Yeah, that's I didn't know that bit of it. So I guess he was justifying it as condensate hedging or something.
I guess. I still don't know how they pulled that off.
Yeah.
I guess. Wait, I have a question. I don't mean to interrupt, but
yeah, we'll go on all day. So you got to interrupt.
Our friend had brought us and brought up a really good point earlier today and said someone argued that product options are so thin they don't even represent the underlying market anymore, which I tend to agree. So do you think that this is causing issues with, say, the crack spreads as well, and then by default, oil as well?
Well, I'll just say, so way back when I was full on, and we were really successful at energy fund. So basically, I would allocate so much to currencies because they're all so. That's one of the big impacts in energy. Given Australia, America, we're the two biggest producers. Then natural gas so much. So I wandered into gasoline. Happen will love this story if he knows his story. So basically, I didn't want to put any more money at risk in oil or natural gas, or Aussie, euro, whatever. So I go into gasoline. This is 8 years ago, maybe 7 years ago. It was that thin then. Uh, I was trying to make a market in options then. There was like 6 players in gasoline doing it. Distillate was even less. Even I made a market for a while in WTI Brent. There was like 3 players. There was 2 brokers that do it. So to me, it's like a natural progression that you do it for so many months, and then something will happen. You'll get caught on the wrong side, and you can't get out, right? And I think it doesn't really affect the crack spreads because I think everyone hedges it similar. You've got to use crude, not kind of like the Aubrey method. No, only joking. You've got to. That's where your depth is. So you put it through your models and work out. Okay, if gasoline's going to do this, diesel's going to do this. How much crude I got to have on? But yeah, it's a very good point. I know Hap still trades gasoline a little bit. Jason and I don't go near that after that a few years ago. I just thought it wasn't worth the time or effort.
If
And
I'm
it's
gonna trade
dangerous.
gasoline, it's usually a crack spread. I'm
Yeah.
scared to death of just outright
But on the
or
physicals,
gasoline.
yeah, yeah.
So if I have a gas view, I'm gonna use a crack spread and take a little bit safer method at it.
Yeah, mine's about, am I gonna fill up at Costco or BP BP, Exxon today. That's about as far as it goes. Um, I think, but you know what, Tracy, it is indicative of how many people have left the financial markets, like the what you see, the Globex markets on energy, because it's a similar fall off on um, oil and natural gas, right? So, but obviously not to that degree, but
I don't
the
really follow the option volumes of the crude products, so I wasn't aware that the activity was low. But part of me wonders if we're just kind of at that perfect price level kind of range here, and because of that, nobody really sees an axe to grind in the near term. That nobody's deploying anything, which makes me wonder if the fundamentals start to shift one way or the other. You see some volume coming back into those options.
well, the reason I was mentioning in the past was what I see is it's always been like that. Just my experience, and it's just got worse and worse. And I think that's what happened. Greg, we're talking about today. So if you're gonna hedge, if you need a position, it's gonna be all done broker to broker. If you need to hedge, sorry, in those. So as someone looking, not unless you have that privy to that information through the brokers, which is why we still have a beer about brokers, you're not going to know what's going on. So fundamentally, it's really hard in those markets, and there's so much misinformation. If you remember how we were going to have no distillate at the start of the year, remember all that? At the end of the world, there's so much false information around our markets from people not in our markets, more than anything.
So what would be then, kind of the where you would get your information that you find is most credible? Because I'm sure there's a lot of traders on here that get caught up in the headlines and things like that. And there is a lot of misinformation out there. So, do you have any go-to sources that you look at that you would like to share?
Um, Well, being in the market for a long time and having been successful, I kind of know most of the big traders. So we will have a chat. You know, as we've got older, it becomes a coffee rather than a beer. So you get to know what's going on, and you talk. So some of those names I mentioned earlier, which I probably shouldn't have, you know those guys, what's going on, and you want to keep a good. So I shudder when I see the word macro on things like Twitter because they're misusing the word. So, but you want to know what's going on as far as the big companies around the world in coal, natural gas, oil, and the trade agreements going on. So I have a good circle of people in government and the big other traders. Then having knowing that sometimes can go against you, right? Because you may be a month ahead of it. So that's why I pay a really big weight on the technical analysis and crowd behavior. For example, I will look at, sometimes you'll get some great discussions going on Twitter, and I will look at how many people push back on your view or agree at your view. Does that make sense? It'll tell me the way the herd's thinking. Because you'll be spot on some stuff, and there'll be people almost yelling at you, you know? So, okay, well, they're short or they're long. Because people tend to, uh, uh, they let
Get
you know what they're
emotional.
doing. Yeah. So the game, so oil is not oil. So who was it who mentioned the other day? It might have been, was it you? So maybe Jason or but what happens is, so oil has Rob, who was, remember when he was a big reporter at Reuters back in the day, but he'll remember, he was there when all the really bad stuff went on in the oil business, you know, and Vitol would just pay a fine, bugger cartels, bugger sanctions and all that. So that's why these things the US has put on the sanctions on Russia haven't worked. So you've got that in the background. It's a very, very imperfect market. The morals have certainly improved. So you've got all that. That's why it's good to hear out of the horse's mouth what's really going on. And I remember I worked in New York for about 2 years. I was up there on the floor. You would never, and so whenever, and I learned this back when I was a big Forex trader, you would never tell people what you're actually doing that would hurt your position. No one ever would. No one big ever does that, right? So I'm sorry if I'm confusing some of the speculators that are small, but if it gets out in a news item, like I'm never going to tell. I got friends at Reuters now, but when I was big, I would never tell them what I was actually doing because I knew that if I was big enough, that would hurt it. And the guy who's trading a euro at Deutsche Bank's never going to tell them what they're doing. So there's so much false information out there. And we see that with the OPEC news, right? Like you made a very good point at the top of this summary, chat, sorry, that you're not going to report on Reuters news till it actually happens anymore because there's so much false news. Because people just want a story. It's all like clickbait. And then you got all these people on things like FinTwit, or whatever we call ourselves, FinX now, is it? That have no understanding and they're just copy and pasting stuff, hoping to get viewers and stuff like that aren't traders, you know? So you've got to have, I think, technical analysis will give you the discipline. Watching option levels, you want discipline or you're going to get caught because no matter how much you know, you're still going to be wrong, right? At times, right? You just want to lower that percentage of being wrong. Does any of that make sense to anyone?
Yeah.
I'm a pure trader, so I'm passing on trading knowledge rather than fundamental knowledge. Jason's when I got a natural gas question about fundamentals, I'll go to Jason 100%. I'm not going to rely on my fundamental knowledge. So
Jason,
yeah,
did you have anything to add?
Go ahead.
Did you have anything to add to that?
No, I was just going to say, you know, if I need some fundamental knowledge on the oil complex, you know, I'm certainly going to hit Andrew and Hap up on those things. that's a totally different animal. So natural gas, what really attracts me to being a fundamental trader with natural gas is that to me it's the most perfect fundamental commodity on the planet as far as being able to track all the checks and balances. And it's because it exists solely on this pressurized system. You know, the second that molecule comes out of a wellhead, it's on a pipeline, and it's either going into a storage facility or it's going to a burner tip somewhere, or, you know, now we've got these LNG send out facilities, but you know, you can't store this on trucks. You can't, you know,
Right.
it's a lot different than oil, and
Yep.
because you know our system over here, our domestic natural gas in the United States, you know, all these meters and whatnot, you've got all these really good services out there that track all this information. So you know, you fire up your screen in the morning, and you know, if you subscribe to some of these different outfits, they've got fundamental reports. They'll tell you, you know, here's where dry gas is coming in today. Here's what the LNG send out is today. Here is the power load. You know, this is the residential commercial, you know, like the heating loads. So all of these little checks and balances, and then we get this weekly report, like you get with the crude complex, of what we've done with storage. And you know, a lot of people always forget this, but storage, this is an equation. Storage equals supply minus demand. So if you're injecting gas, that means you have more supply for that week than you did demand. And then when you get into the winter, like we're going into now, you would expect, you know, with the heating loads coming up, that you would have more demand than supply, and you're withdrawing. So we get that number every week to kind of give the fundamentalist a check of where the supply demand balance is. And I have yet to find a better fundamental market than natural gas.
Yeah, 100%. I mean, I think simply it's because it's so domestic, and when we get basis level, it's even more. So, I mean, Henry Hub is Houston, so Jason and I probably have an advantage knowing the weather and all that and oil, and but each one's different, but it's less easier to rig, I guess. Would that be a nice way of putting it? Than oil, whether it's intentional or not. Though, I mean, OPEC to me is just no different to it's just another cartel, right? And but there's now so many different markets on oil, and it's so easy to manipulate. Not, and I don't mean intentional manipulation. I don't mean rig. I just mean if I mean, so the Vitals and the Trafigurs and the Glencores are just have such a big wide range, and their book isn't just WTI, or it's the different physical points. It might be a currency hedging the way vertical or horizontal, the way Exxon will do it. So all these factors can influence oil. And if you've noticed, the real easy oil trade comes right around the roll. So OPEX used to be a really good way to make money. But now what we're seeing is, because the optionality's changed, the futures will have a really good sell-off or sell. And it's been a sell-off because the specs have been getting long, waiting for that big war to happen or whatever, you know, the $100 oil. So you've been getting these big sell-offs at the roll every month on WTI. That's been a real easy trade. And in 1 or 2 sessions, that'll move $8 or $9. You'll make your whole money. And you got to look where you have an edge. So we're all human. We don't have an edge over an algorithm. So then the reason our technical analysis works is because that's what the algos are doing right now. So like if you just look at today, right? What was the low of today? It was an exact high of yesterday, right? Which was a breakup. And you look at the high was, you know, just short of 78. So you've got your option work being done on all these levels. So if you know your option levels and you have a broad eye, because a chart is, back when we first started trading, Jason, we didn't even have charts, remember? So now it just makes it so much easier. Think of them not as some magical thing, just telling you where everyone is. Most traders are visual, and also one thing I've been fortunate enough to meet and know people like Tudor Jones and that, where he made most of his money was as soon as everyone panicked buying or panicked selling, he'd watch the stop and go the other way. And if it didn't break down, then he would join on to them. So I think they called that a throwover, or he did. And that happens nonstop in oil, and in thin hours too.
Absolutely. We have one question from the audience from my friend Piotr before we go to the final round, because we're coming up on the hour and I don't want to take too much of your time
I'm
today.
getting hungry. So
So Piotr, go ahead and you can ask your question and then we'll do the final round, you guys.
Yeah, thanks, Tracy. And bear with the voice. I'm coming out with a coming out from a cold, rather. Thanks for the chat, guys. It's been interesting. I've got a little bit of a very time-sensitive question for you, because it particularly relates to oil, and it might require a bit of speculation. So if you don't want to do that, no worries. But as we speak, there is a buildup of forces on the border between Venezuela, Brazil, and Guyana, because there is reports that Venezuela may be about to launch some kind of annexation of part of Guyana. Now, Guyana's been the fastest growing economy for several years because of the oil fields that were found north of it by Exxon in 2015. So, if this were to happen, this would cause obviously quite a big repercussion in the already very volatile energy/oil markets. I'm kind of curious what you think that could mean, given everything else happening around the world in the Middle East, Russia, and so on. Thanks.
Well, I think specifically that would be a big issue for Exxon and Chevron, because they just bought into that as well, right? So for Exxon, they've switched a lot of their production. For example, they sold out of Iraq and places like that. So Guyana is very important to them. I just wonder how much of that is just noise, because Guyana's been very complicit, if you'd like, with the oil companies over there. If that happens, that would certainly be a big game changer. People like Exxon. As far as oil goes, I think so. I learned many, many years ago not that many years ago, but when peak oil was, everyone would go on about peak oil. Some old oil people that weren't just only buy, only sell. They said oil always has a way, and iron ore is the same, of finding new supply. And remember, fracking came along, then fracking got even more efficient, vertical, etc. And then Guyana came along. So this one looked to be the safe one, didn't it? So that is a big thing. I think more than the Middle East.
The only question I would have about that is, unless there is some kind of infrastructure attack or damage or port blockade or something like that, if the flow doesn't stop, I think that goes back to what Andrew was talking about with Tudor. You get the headline panic and oil, ramps $10 on that. But when you look at it and you see that the flow hasn't changed, it's maybe that's a selling opportunity. I don't know, but
It's all off.
I think
in Guyana.
I think
So
you would have to do some kind of shipping blockade or damage to pipeline facilities or whatnot to really actually impact the supply demand balance.
actually,
Other than that, like a tradable headline.
yeah, and on that, if you remember Nigeria, remember the pirates and everything. So a lot of basically, so Noble Drilling was big there. Exxon was big there. So all of these guys had their own portable armies, really, police forces. So they would be protected from all that sort of thing. I would guess, I'm not privy to it, that Exxon, et cetera, has very similar stuff going on in Guyana. And that's a good example of why when Biden was threatening the oil companies, so in the start of all this, they weren't changing their production. They're very much running their own show now and rely and trust no one else. So it's going to be one to watch. I haven't been too familiar with it. And Venezuela really, they're kind of like, in rugby terms, they would be like Romania threatening South Africa, I would think. They kind of got nothing at this point, politically and strength-wise.
That
No
makes sense.
offense to anyone from Venezuela.
Right. And then, I talk about Venezuela all the time, but all right. On that note, we're going to do the final round. The final round is the same question for both of you. And is what should we as traders, investors, or first you can talk about something that we haven't talked about that you want to talk about, and or really what are you keeping your eye on most in these markets over, say the next 6 to 12 months?
Well, I think a lot of what we've seen is we've got so much into this herd mentality. So I watch the carry trade more than anything. That's what's really worked really well for me. So basically when dollar yen turned up, it brought everything else up with it. So I'm watching dollar yen. We're talking a bigger exchange structure. And then I watch how the carry trade lifts everything up and down. So I'm going to watch the CDSs. And I think the markets have become so broken and manipulated. It's not worth you can't just look back at what's happened in the past and assume it's going to happen moving forward. It's so different. We've had all the manipulation with federal banks, with QEs, we've got multiple wars going on, et cetera, et cetera. I think we've actually already had the recession for what it's worth. I think when they manipulated the numbers a few years ago, if you remember that, they said, oh, we're not in a recession because there was an election going on. So we're at different cycles. And I think the stock market, I just look at Apple, S&P, how they're faring, because that's all they're buying. The central banks are buying these stocks. So like, Norway, Swiss National Bank, etc. So they've become like bonds. So as far as that market goes, as oil, I'm just going to keep trading it the way I've been trading it, like I said earlier. And natural gas, pretty much the same. There's 3 or 4 times a year you want to jump into it. And as far as short-term trading, it's almost like you got to trade the reversal because that's what the algorithms are doing, and that's what's running pretty well everything. That's my take on it. And then I'm getting ready for Christmas.
Okay. And then Jason, same question. We can talk about something that we haven't gotten a chance to talk about, and or what should we really be looking at in these markets over the next 6 to 12 months, say?
Well, as far as natural gas is concerned, I'm just kind of keeping my eye on when we possibly could see some rollover in production levels out of some of the basins. Permian's associated gas, so unless oil tanks, I don't really expect you're going to see any gas declines out of that basin anytime soon. But Haynesville, keeping an eye on that basin, looking for maybe a peak and a pullback there, which has not happened yet. Marcellus, they they haven't really had any pullbacks, and in fact, they've kind of ramped up seasonally, which they do when the weather starts to get cold. You start seeing some stuff that's normally kind of pressured down a little bit start coming back up. So I don't see any big, larger trending trades to be set up in natural gas right now in the short term. But I do think if you start seeing, production peak out and start to roll over, start paying attention to, the activity in the fields, with rig counts and frac spreads and whatnot. But outside of that, I'm just I'm playing short term, small gain type stuff, just looking at where the market setup is. Like, I said earlier, gas has cycled down from, quite a bit from where we were just several weeks back. And, now we have a short market. So we're kind of looking for something to light the fuse here, which most likely will be, the promise of some colder weather coming, a different pattern shift. So I think, you're not going to see some big trend off of that, but, you could wind up with a 30, 40, 50 cent move if the weather's good. But outside of that, it's a grind right here. The macro fundamental picture for gas is not bullish at the moment. So you got to just make short-term trades. I kind of laugh about the boil. Every person that comes into boil with the idea of trading it inevitably becomes long-term investors. They get stuck in that cycle. I saw this metric from the inception of Boyle when it first came out. If you invested $10,000 in it, I think you would have I don't know, 150, $200 off your original investment. It's down like 99% or greater just from these rolls, that contango just eats it.
Yeah.
Yeah. So it's a terrible tool for
It's the
trading outside
Salvation
of maybe
Army
like
of trading.
a really short-term trade. Hey, I'm going to go and buy this and I'm not going to have this for longer than, a week or two. But, when you're trying to pick these items up for long term, inevitably, unless you get a large trending move, you're more than likely going to lose money on these instruments.
Actually, just on that, if we think every big natural gas move, other than that war in Ukraine, they've all been from the market getting really complacent, vol, and really big paper positions. Every squeeze, they're usually been really big squeezes up, or just a total collapse. Unexpected because everyone's the same way. And just my final thought is keep an eye on the Goldman Sachs has a short index, and that's just up phenomenally this year, and that explains pretty well everything that's happened. In the markets, from bonds, stocks, you name it. So keep an eye on that. And that, to me, the market getting too much the one way on commodities. And the best example is lithium, how that was going to be the big thing of all time. They today in commodities and natural gas and oil, the rubber always meets the road. So always keep that in mind,
Yeah,
Yes.
I don't disagree, on oil. I mean, that's, as that's not really my area of expertise, but from just kind of a global and domestic macro view, I kind of hold the belief, and it's not, Andrew mentioned he thinks recession's over, and I can't really disagree on a true recession, but I do think,
What I mean is, I think we went into recession like a year and a
oh
half
yeah,
ago.
yeah, yeah.
That's what I mean.
Yeah, where they changed the definition of recession.
Because it may pretty damn well. We're doing pretty damn good in America. I mean, maybe it's different in Texas to other bits of America, but it's not as if we're about to, So it makes more sense that we're further along. Statistics do it. We're not as politically extreme down here, I guess. People kind of mind their own business. So it all fits in with that analogy, I think. Does that make sense?
Oh, absolutely. I was just going to mention that, you know, I'm a pretty firm belief that the rapid ramp from, basically zero interest rate bonds up to what we're at, what, 5.5 right now, I believe. I don't think that has fully worked through the system yet. I think the lag of that is gonna hit up in Q1, and I personally believe that these equity indices are gonna get hit in Q1. I think that we're up at least in the Nasdaq. We're up not far off of the all time highs, which were
Mm.
created when we had that, zero interest rate policy and, mortgages were in the 3% range and, money was flowing. You had all the money from COVID, mailbox money that was sent out, the trillions of dollars that was in the system.
I'm
And
still waiting for my check.
and all of that worked these indices and these stocks up to these crazy levels. And all of that has been removed.
Well,
We've
I
removed
think
money from M2. The rates are up here. I've been reading some data points on the Christmas spending this year, how they're utilizing the pay later function, and it's like I had
well,
I
we're
had
going
a
to get our
phone
Christmas
call.
presents this year.
I had a phone call from my mortgage company 2 weeks ago, unsolicited. Saw they were calling in. What do they want? The guy says, "Hey, I see you put in a request for a payoff." And I said, "No, I didn't do that." And he's like, "Well, while I have you on, would you be interested in doing a cash out refi? Take advantage of your equity to maybe pay down some bills or make a purchase." And I go, I have I think I'm at a 3.5% mortgage rate. I go, why would I do that right now and refi into, a 7 or 8% mortgage rate? And he's like, well, everybody's starting to do this to pay some bills. And that tells me
Yeah, I think they're lying.
that's telling me if that's true. Why I did ask a friend who's in that business. He said, yeah, they are doing a lot of cash out refis right now. That tells me the consumer is in trouble. If they're willing to separate from a lower mortgage rate just to get money for their expenses, that's problematic.
Well, I think there's a percentage of that, but I think you hit the nail on the head. And I think this is what's really caught a lot of people short and distorted. There's so many people on low mortgage rates, and people became more conservative. I don't mean politically, but conservative with their money, fiscally conservative when COVID happened. So and you saw that in this recent Black Friday shopping, people were more selective what they bought. They're buying stuff on discount. I think people have just got. I mean, there's a percentage that have got worse, right? They're outright all that sort of stuff, whatever they're doing. But I think it's just really different to what a little people perceive, and that's why I just keep everything kind of simple in trading and life is you just there's so many distortions caused by so many things, so many bifurcations as what they would have taught us at school. Who knows? So, and how many wars have we got going now? Who isn't at war at this point, right?
And with that, on that uplifting note,
Yeah, we need to go. I'm getting the wind up.
I've got another podcast.
Damn, you busy.
I want to thank you both very much for spending your time with us today. I'm sure our audience thanks you. Definitely follow these guys on Twitter. They put out a lot of good information. And with that, thank you everybody for attending, and we will see you next Wednesday.